The US dollar, long the bedrock of global finance, has stumbled, plunging roughly 10.8% in the first half of 2025, its steepest six-month dive since 1973, when President Nixon ended the gold standard. What's behind this sudden crisis of confidence, from erratic tariff and deficit policies to concerns about the Fed's independence? Can the dollar still defend its status as the world's go-to safe haven, or is it losing its grip? Let's find out. When discussing the US dollar, it's essential to distinguish between a collapse and a market correction. In finance, a market correction occurs when an asset's value falls by 10 to 20% from its most recent peak. According to Investopedia, corrections typically last a few months and are part of healthy market cycles. They're steep but recoverable dips, not fundamental breakdowns. For example, the S&P 500 often undergoes corrections, with most reversing within about 100 days. Applied to currencies, a similar dip, like the US dollar's 10% fall, may reflect shifts in interest rates, economic forecasts, or short-term sentiment. But on the other hand, a currency collapse is dramatically different. It signifies a severe and rapid loss of value, often due to hyperinflation, mass capital flight, a collapse in trust, and collapsing economic fundamentals. Classic examples include the Zimbabwean dollar in the 2000s or the Argentine peso in the late 90s, where economies spiraled into crisis, monetary systems broke down, and government interventions proved ineffective. Now the US dollar has recently dropped about 10%, qualifying it technically as a market correction. While significant, this decline lacks the signs of extreme capital flight, hyperinflation, or systemic failure that are endemic to a collapse. But what's causing this drop? Several interconnected factors are combining to pressure the US dollar downward. President Trump's stepped-up tariffs on Canada, Mexico, China, and others have stoked fears of global trade disruption and imported inflation. These moves have undermined confidence in the dollar's safe haven appeal. Another factor is the proposed Big Beautiful Bill, a tax cut and infrastructure package. The bill could add about $3.3 trillion to the national debt over 10 years. Analysts warn that this fiscal splurge may trigger long-term inflation and undermine the dollar's credibility. And that's why the US Fed is resisting rate cuts. While some Fed officials signal caution, markets are pricing in 2 to 3 rate cuts in 2025. Cuts tend to weaken the dollar by reducing yields on dollar-denominated assets. JP Morgan notes that when rate cuts follow slowly, both the dollar and Treasury yields drop, a pattern unfolding now, as investors brace for slower growth with inflation still sticky. Investors are also shifting away from dollar-denominated assets. A recent Reuters poll shows over 80% of FX analysts expect further dollar weakness through July, citing debt concerns and inconsistent trade policies. Morgan Stanley reports foreign buyers of U.S. Treasuries are retracting, weakening demand. Goldman Sachs noted foreign equity sales totaling around $63 billion in recent months. With global volatility, many investors have shifted to gold, which surged 25% in the first half, as well as the euro, yen, and Swiss franc. Inflation concerns are also fueling the collapse of the US dollar. The weaker dollar makes US imports, from smartphones to pharmaceuticals, more expensive, adding to inflationary pressure and potentially prompting further Fed intervention. Once granted cheap borrowing due to global demand, the dollar's power is being questioned. Deutsche Bank, Société Générale, and Goldman Sachs warn that persistent debt and unpredictable policies could spark a long-term confidence crisis. But does this translate to a collapse? The short answer, no, at least not yet, because the US dollar still makes up around 58% of global foreign exchange reserves, well above the euro's 20% share. According to central bankers at an annual Sintra gathering, no viable challenger is on the horizon, and any significant change is likely to be many years away. ECB head Christine Lagarde emphasized that, although investors are exploring alternatives, structural reforms in Europe or China would be necessary before they can challenge the dollar's dominant role, as the global support mechanism remains active. Even amid stormy rhetoric, the Federal Reserve has maintained its currency swap line network, a critical lifeline providing dollar liquidity to global central banks, signaling commitment to financial stability. The Financial Times Kindleberger trap analysis notes that the Fed's role as lender of last resort remains intact. Cutting it off would pose the real risk of collapse, but so far the mechanism stands. Institutions like Morgan Stanley argue that the dollar is undergoing a cyclical reset, not an existential failure. While interest rate cuts and slowing growth dent the dollar, its dominance endures. James Lord at Morgan Stanley says predicting the dollar's demise is greatly exaggerated, given its centrality to global banking, trade financing, and cross-border lending. And despite the recent drop, global demand for treasury bonds remains relatively strong. Yields have fluctuated, but not enough to trigger widespread panic among foreign sellers. Analysts note that in many crisis cases, treasury demand spiked. This time, it has moderated, but not collapsed. Another factor indicating that the US dollar isn't collapsing is that there is no apparent substitute in sight. Global transitions in reserve currencies require a clear, credible alternative, a role that the euro, yuan, or stablecoins do not yet fulfill. Even the BRICS nations and central banks moving toward de-dollarization are doing so gradually, rather than in a sudden abandonment. Although the dollar hasn't collapsed, it is showing signs of strain, and several key vulnerabilities bear close watching. First, policy fragility is a real risk. Persistent political interference, from tariff escalation to public questioning of the Fed's independence, has shaken centuries of trust in the Federal Reserve. Economists warn that such meddling could erode the bank's credibility long-term. Second, America's rising debt burden is piling on the pressure. With budget deficits projected to expand by $3 to $4 trillion over the next decade, financing costs are climbing, and this could compound the dollar's weakness. Finally, a global narrative shift may be underway. A recent sell-off of treasuries, driven by fear that the dollar's safe haven appeal is fading, suggests investors are beginning to question whether U.S. assets can still be trusted. Altogether, while not terminal, these risks paint a clear picture. The dollar's foundation remains intact, but only so long as confidence does. But what if the U.S. dollar actually collapses? Since the dollar is the world's primary reserve currency, a collapse would create sharp disruptions in international trade and finance. Countless countries hold reserve assets denominated in dollars. A dramatic plunge would wipe out trillions in value, destabilizing global institutions that rely on dollar-denominated reserves. Many nations, especially those pegged to the dollar, would face currency chaos as they scramble to float abruptly, echoing the severe volatility seen in places like Venezuela. A collapsing dollar would sharply raise the cost of imported goods, from energy to electronics, triggering immediate inflation and eroding household purchasing power. With inflation skyrocketing, the Federal Reserve would struggle between tightening policy or risking further drops in value. A collapse would also unleash chaos across global markets. Investors would probably liquidate dollar-denominated assets, sparking sell-offs in U.S. stocks, government bonds, and mortgage markets. U.S. mortgage holders could see interest rates spike and financing dry up, while U.S. multinationals would suffer as foreign profits shrink in value. Domestically, the U.S. government's ability to borrow cheaply relies on global confidence in the dollar. A collapse would force interest rates higher, ballooning the cost of servicing national debt, which is already slated to rise from 100% to 130% of GDP in a decade as a result of recent fiscal bills. This could trigger deep spending cuts, higher taxes, or aggressive money printing, intensifying inflation in a vicious cycle. A collapse would dramatically alter the international order. Nations and corporations may rapidly shift away from the dollar toward alternatives such as the euro, yuan, gold, or emerging central bank digital currencies. Such a transition would likely spark a multipolar currency regime, reducing U.S. economic and geopolitical leverage. As we wrap up, remember this: the dollar's recent decline, roughly 10% in the first half of 2025, is significant, but it doesn't spell catastrophe. The dollar's deep-rooted role, as a reserve currency backed by robust institutions and global reliance, continues to offer resilience. Still, the risks highlight a crucial point: complacency isn't an option. A collapse remains unlikely, but not impossible. Share your opinions in the comments, and don't forget to subscribe.